First of all, we have been debating for the last several quarters about where is the US economy going to end up. Is it going to end up in a recession, a hard landing, soft landing, keep zooming through the way that the Q2 numbers seem to suggest? And along with that, where are the US yields really going to settle, and what does that mean for their monetary policy and our own? Then another thing that Mr. Ghaswala just talked about, what is really going to happen in the Middle East? How far is that conflict going to prolong? Now, going back a year and a half when the Russia-Ukraine conflict started, I suspect a lot of us were hoping that it would end pretty quickly. And I certainly didn't expect it to carry on past last winter, because I thought that fuel prices, gas prices in the winter were going to be the clincher that would end up finding a resolution one way or another. That didn't happen. That's still continuing and being overtaken now really by the Israel-Hamas conflict. And then coming back to something closer to home, we've had this strange flare-up between India and Canada. How long will that last? Direct trade is limited between these two countries, but in some specific products, there is a dependence on Canada for imports and for exports. The China factor, very important for sentiment in global commodity markets. What is really going to happen there in the real estate sector overall with their politics and economics, and what does it really mean for commodity prices? We're a huge commodity importer and a price taker, so this does have implications for us. And coming to Europe, how much really is the slowdown going to be across Europe? Is it going to be concentrated in a couple of countries or become very widespread? And coming back to what I was talking about, how much longer will the Russia-Ukraine war continue? Now, in all of this global uncertainty, we've had India in a shining moment. And here what we have for you on screen is the GDP growth numbers for Q1 of FY24 for India and a bunch of large economies. And you can see that India's GDP growth in that quarter far outpaced what we saw in the rest of the world at 7.8%. You would have heard in the last week or so the RBI governor saying that the growth in Q2 is going to be higher than what the Monetary Policy Committee had been suggesting. That's actually something we've been saying for a long time. The MPC expected GDP growth in Q2 to come in at 6.5%. We've been saying for a long time it's going to come in at 7%. And part of the reason for that is that the commodity price benefit that we got in Q1 has remained a tailwind in Q2. But going forward, there are 5 reasons why we expect GDP growth to actually slow down in H2 and come in below 5%. So if you see over here, what we got for you on this slide is the blue line is the actual numbers that we have so far from the NSO up to Q1. And after that, we have ICRA's estimates in the yellow line and the Monetary Policy Committee's estimates in the green line. And you can see how they're really diverging over the next 3 quarters. We are higher than the MPC for Q2 and well below the MPC for Q3 and Q4. So before I get into the micro reasons why we are not bullish on H2 in terms of the headline numbers, let me add that India remains a beacon of macroeconomic stability in an uncertain and turbulent world. And I am by no means bearish on the Indian economy. But as finance professionals, I believe that these micro numbers are also very important to you. So I'm just going to spell out what are our reasons behind our forecast for this near-term dip that we're expecting in the second half of the year. Firstly, we've had a pretty uneven monsoon. I mean, it really has not been a good monsoon by any stretch of the imagination. Reservoir levels are also trailing both last year's levels and the historical averages. And the first round of estimates for the Kharif crop that we've got from the NSO with a bit of a delay, the numbers are not looking good. Rabi sowing has taken off reasonably well. It's 4% higher than last year, but less than a fifth of the sowing has actually been done yet. So the early number may not be very meaningful. For almost all high frequencies, we need to keep in mind that this year Diwali is significantly later than last year. So year-on-year comparisons are going to be very misleading between September, October and November. Mostly we should be really looking at averages going ahead. And I have a feeling that once we get into the Diwali break, the sowing numbers are going to start falling back and then perhaps be very close to last year's levels, not 4% higher than last year's levels. Second reason why we do think we are circumspect on the second half is that we still have the cumulative impact of monetary tightening playing out in the system. and this is something that will emerge as more of a bit of a headwind as transmission picks up through the economy in the second half, which is typically the busy season for credit. Third reason, now here we've got the commodity price index, the Bloomberg commodity price index. So if you look at the blue line, that's where the BCom index was in FY23, and the yellow line is where it is in FY24. So you can see that there was a huge differential in Q1, and that's the tailwind of commodity prices that we got. And all of you would have seen that your margins, of course, every sector is different, but in many sectors, margins would have significantly gotten a breather in Q1 and in Q2 from the YOY decline in commodity prices. Now, if we just assume that commodity prices stay where they are and project forward at 105 for the BCom, we're going to find a major narrowing in this tailwind going ahead, and then in Q4 we may even reverse. Flip side, if there is a broadening of the conflict in the Middle East, there is a possibility that at least some commodity prices could harden, and that we will not remain at this 105, we'll go up a little bit. But our general expectation is that commodities will remain volatile in a narrow band, and therefore we don't expect any kind of a commodity super cycle other than crude oil. Crude oil has its own dynamics, and supply is a much bigger factor than demand in parts of the year. So having said that, the tailwind from commodity prices is certainly something that may not be very helpful going ahead. Then good news and bad news. Good news, the government seems to have been very prescient this year. They have front loaded their capital expenditure. We've seen them do that for the central government's own capex. We've seen front loading of the approvals for the capex loan scheme for the state governments, and we're seeing it in the state government numbers as well, that on a low base their YOY expansion is quite high. This is all great because it means that we've got an engine of growth that is chugging along well in the first half of the year. But there's a twofold issue. One, we are getting close to election season. Once a model code of conduct is in place, capex naturally slopes off. Second, if you've done a larger part of your target in H1, there's just less left to do in H2. So the YOY growth again will get compressed. Even if there were not the elections, the YOY growth would have looked lower in the second half. So this is another reason why the outcomes for growth in the second half of the year may be somewhat constrained compared to the first half. Now coming to the private sector capex cycle, I hear lots of different opinions and lots of different observations around this. I shouldn't call it opinions, but everybody's observation for their own sector may be quite different. And it's an amalgamation of that that really tells us what's happening with capital formation in the country as a whole. So if we look at the ingredients for a private sector capex cycle, a lot of the ingredients are in place. We've got capacity utilization at that 75% mark broadly on a seasonally adjusted basis, which is typically where we see a lot more of private sector capex coming in. We have interest rates which have gone into a pause mode for the last few quarters. Very low likelihood that interest rates will go up from here. The downside, the down cycle is not going to start immediately. It's a few quarters away at least. But also the down cycle is not going to be very deep. So there may not be any point in waiting for interest rates to be lower. If there is conviction that demand in your sector is going to be good, I do expect that a lot of companies are going to be willing to go ahead and announce capex. And we are seeing capex get announced in a variety of sectors. It's not big bang capex. So our expectation of this capex cycle is that it's going to be very measured. It's going to be a very mature capex cycle. It's not going to be large announcements that are difficult to follow through on. And we are seeing modestly sized capex announcements coming in consumer facing sectors like autos, even EV. We're seeing it in the services sectors like hotels. There's a lot of capacity that will get added over the next few years. Airlines, I mean, we've got two of the towers over here are the airlines orders, which have gotten placed and which will get delivered over a long period of time. And we've got the new age sectors as well. We've got data centers, traditional sectors like cement and steel. So there is capex happening on the ground. It's not big bang capex. And a lot of it may also be funded through internal accruals rather than through bank credit. So that's another reason why it may not be as apparent in the credit growth numbers, for instance, because a lot of it may be a beneficiary of the deleveraging cycle that corporates have gone through in the last couple of years. And the last sort of headwind which is persisting is the tepid global growth and the impact of that on our exports. So what you can see here is that our merchandise exports have been contracting now for many of the last few months, and service export growth has come off very sharply. If we stack up merchandise and services exports on top of each other, together they are now in contraction mode. So this is definitely something that is an issue. There is a volume problem and there is a commodity price problem as well. Between the two of them, we've got the value of exports being now lower than what it was last year. So for the year as a whole, we expect GDP growth to come in at 6%. 7% plus for H1, less than 5% for H2, 6% for the year as a whole. And for FY25, our baseline projection is that growth will come in at 6.2%. There would be a little bit of a deviation over here depending on exactly when the elections happen, when the budget is presented, etc. So Q1 outcomes could be different from what we are projecting right now, and that could lead to actual growth being in a band of 6 to 6.5%. But for the baseline, we're using 6.2% right now. Now, from growth, I'm going to move into inflation, a very topical issue, very emotive issue in a country like India. And we do expect CPI inflation to soften in the current year on average as compared to last year, but it's going to be far away from that 4% target that the RBI governor has repeatedly emphasized over the last few months. So for FY24, we are penciling in a CPI inflation of 5.2%, with food inflation being far higher than that. And our baseline expectation for FY25 is a CPI inflation of 4.7%. With food inflation coming in at 5.3%. And in this 5.3% food inflation, we've assumed that the monsoon will be normal. There is typically one vegetable price shock every year between potatoes, onion and tomatoes. I mean, something or the other goes wrong every year. Typically that will happen next year also, and we'll have to deal with it for a few months, and headlines will be very exciting for those few months. Now moving on to the fiscal side. So, okay, just to go back, since the RBI governor has spoken so much about the target for inflation being 4% and not just below 6%, this is what feeds into our expectation that the rate cut cycle cannot start before August of next year. And when it does start, it's likely to be limited to 50 to 75 basis points. So, broadly, we would expect one rate cut each between the August, October and December policies of next year at best. I'm sure somebody will ask me during the Q&A how the Fed's decisions will impact our rate cuts. I'll leave it for the Q&A and move on for now. On the fiscal side, we have lots of positives and negatives for Government of India's own fiscal balances. But in aggregate, our expectation is that this year the government will be able to stick to its fiscal deficit target. We don't expect there to be a material overshoot. I'm hearing that tax collections are now forecasted to be much higher than budgeted. I'm not sure. I will still wait for at least the December advanced tax data to stick my neck out on whether they're going to be much higher than budgeted. I think they'll be a little bit higher than budgeted. So overall, we do think that there is a very limited risk that the fiscal deficit will be breached in a meaningful manner. Of course, there are some concerns. Fertilizer subsidy will be higher than what was allocated. Narega needs a little bit more of an allocation. LPG subsidy has already been increased and the food subsidy has been extended. So all of these, if we say together, will cost about 1 lakh crore more. Disinvestment will be a little bit lower than budgeted, but tax and non-tax revenues being higher than the target could absorb all of this. And so we don't think that there is a material risk to yields from the government's own fisc. Now for the next 2 years, the fisc is in a very interesting position because the medium-term target is to bring down the deficit to 4.5% of GDP. And if we assume that this reduction is split evenly between FY25 and 26, then that has implications for either compressing the revenue deficit or for having a more moderate growth in capex as compared to what we've seen in the last 2 years. So that is something that we have to bear in mind, and having spent most of my adult life with a rating agency, fiscal consolidation is something that absolutely must remain a priority, and within that, as much capex growth as can possibly be allocated, that is broadly where we would like to see the policy direction moving. Now, on the other twin of the deficits, the current account, the picture is looking quite comfortable. About a year and a half back, this is one of the macro indicators that we were most stressed about for India, because it looked like the current account deficit was pushing to 2.5–3% of GDP for FY22, for FY23. And that didn't turn out to be the case. We were able to contain the current account deficit at 2% of GDP, and we broadly expect it to remain in that range in the current year and in the next year as well. So not much of an alarm situation coming out of the current account deficit. Forex reserves remain quite large, even though there is a lot of week-to-week volatility. And for the exchange rate, we've seen deft management, and we've seen it being extremely stable to the dollar. Of course, not so stable to other emerging market currencies, but at least to the dollar, we've seen the rupee being really quite stable despite all the headwinds. So I am going to now wrap up with 3 slides summarizing our outlook for FY24, FY25, and then just some medium-term thoughts before we move into the Q&A. So for FY24, real GDP growth at 6%, nominal GDP growth at about 9 to 9.5%, CPI inflation to average 5.2%, WPI to be flatlining at 0.2%, very negative in the first half up to the October print, possibly coming out of deflation from November to March. Repo rate, no change in the rest of this fiscal. Fiscal deficit to be broadly contained at the budgeted level, and the current account deficit at 2% of GDP. For FY25, real growth at 6.2% of GDP, nominal GDP growth again coming in that 9 to 10% band, CPI inflation at 4.7%, WPI inflation to really depend on where commodities end up next year, but 2 to 4% is broadly our expectation. Shallow rate cut cycle to start in August of next year, possibly go up to December of next year. Fiscal deficit possibly to be budgeted at 5.2% of GDP, and a current account deficit that will be fairly stable. On the medium term outlook, now here I have some thoughts, observations, and maybe some apprehensions as well. So first observation, or let's see, thought. We expect the potential GDP growth for the Indian economy to be around 6.5% over the medium term. And here, domestic consumption will remain a huge driver. How much money can be put out for infrastructure and for capex by the government will definitely play a role. Project execution capabilities will play a role. We don't expect the external environment to be terribly supportive. So domestic manufacturing and services exports will have to increase their market share in the global scenario. We cannot expect the global trade pie to expand too much. We have to nudge our way into supply chains to take away from China, and PLI has to work, which we can see in some sectors, but that needs to become a more broad-based success story. The apprehension is that a potential GDP growth of 6.5% is not consistent with a sustained inflation at 4% or below. We do think that average inflation in the Indian context is going to remain between 4 to 5% for the most part. Even if commodity prices remain relatively stable, domestic demand being the primary driver of India's growth means that we are going to have core inflation being on the higher side going ahead. And that demand will feed into stickier prices, into higher wage expectations, etc. going ahead. So this is something that is a little bit of a mismatch in terms of where the MPC would like inflation to end up vis-a-vis what we think is realistic given where we think growth is going to end up. Fiscal deficit, like I said, to come down to 4.5% of GDP will either require a large amount of compression of the revenue deficit, which will mean weeding out more of the bogus beneficiaries, things like that, having more of efficiency coming in on the cash management system, or measured look at some subsidies going ahead. If not, it's going to mean that the space for growth in capex will be quite limited. And at this point, we have penciled in extra capex of only 50,000 crore each in FY25 over FY24 and FY26 over 25. So the increments in capex going ahead will be modest compared to the very large increases in capex that we've seen the government budgeting in the last 2 years. Private sector capex, like I said, all the ingredients are in place. We do think that is going to be a measured capex cycle instead of being a big bang one. And a measured capex cycle will probably end up being more sustainable and being more likely to actually fructify rather than big bang announcements which we've seen fizzling out over the last couple of decades. And India's export growth to be constrained by what's happening in the global economy. So a great need to be able to make our presence felt in supply chains. Lastly, with where different large global economies are, we don't expect a commodity super cycle to emerge anytime soon. Crude oil, I talked about this earlier. Our view is that the world economy is not in equilibrium if crude crosses $100 per barrel. So that seems to be a natural cap. While bad news can push it beyond $100 per barrel, it retreats. Broad range for crude oil in business as usual would be 65 to 85. It's a very large band, but we see crude being that volatile every year. If it's down to 65, it's great for us. As consumers, as an economy, 65 is really great for us. But it's unlikely to remain there for very long. And 75 to 85 as a band may be something that we should be prepared for as an economy and as economic agents for crude to be in that band. If it pushes past 90, we may have to live with it for some time, but I do believe that naturally it will trend down. This is my gut feel as an economist. By no means am I an energy specialist. Let me just add that caveat. Lastly, on the rupee, what we feel is that the RBI has been able to keep it quite steady. If there are event risks, then that is certainly something that may lead to the RBI breaking through, the rupee breaking through the band that we've seen with the INR over the last few months. But other than that, we expect it to be quite stable relative to the US dollar. So with that, I'm going to end my prepared remarks and over to you.
Check. Ladies and gentlemen, the floor is now open for a quick Q&A session. Kindly raise your hands and we shall pass on a mic to you.
Hi, I'm Jadip. So okay?
Yeah.
I'm Jadip. I'm from NIT. I'm not an economist. I'm also from a finance background. I just wanted to know, when we compare these numbers with other countries, is the GDP formula to calculate them are universally same across the world?
Yeah.
They are?
Yeah.
Okay.
Were there any more questions at this point?
So my name is Gaurav Khan. I'm part of Sham Spectra. My question is coming out of your first slide where you were talking about US and China and all that. So one change that I have seen, and I would like to take your comment on that from an Indian perspective, that before COVID and during the COVID period, if you were presented the same slide, China would have been on top, right? Like it was a concern for us, or we were looking up to China for their policies and what they're talking about. And globally also people were looking at China. Is this move is only on slide, or is actually happening that now we are talking less on China and other factors and global factors have overpowered when India is looking for their growth prospect?
I think you're quite right. I mean, China has been mired in a whole host of domestic problems over the last few years between COVID and their extended lockdowns, their own property sector related issues, and also lots of phases of the rest of the world being quite angry with China and wanting to get out of their supply chains and move their manufacturing then I mean, we keep hearing conflicting news about how some countries are going back to China and admitting that their dependence on China is very high and we really can't move out of there. But overall, I think it's been a phase of intense internal turmoil in terms of their own political and economic situation and the culmination of geopolitics. So we're certainly talking a lot more about what's happening in other parts of the world. I think the last year and a half, possibly other than the conflicts, I mean, really what's happening in the US economy, that's been something which has been very paramount. A lot of market economists tend to time their forecasts for when the RBI will move rates to when they think the US will move rates. And as a predominantly Indian focused economist, my view is that the RBI can think of mirroring what's happening in the US Fed only if our own domestic growth economic fundamentals will allow that. But if our domestic growth economic fundamentals are moving in a different direction, then they're not just going to simply copy what the Fed has done last, right? So looking at that, I mean, a lot of market economists, because their US counterparts would have expected the Fed to start cutting rates in February, I would keep being countered saying that, oh no, the MPC will start cutting rates in February as well. And I said, how can they? I mean, what is your inflation forecast that you think will allow the RBI to do that? Now that the talk of the US Fed delaying rate cuts has started in the US, I find that the Indian market economists are now willing to concede that our rate cuts will also come in later in the year. So I think these have been more topical issues. We've definitely put a lot more mind space to what's happening in the US and what's happening in the conflicts.
Thanks. And one more point, and we mentioned a lot of topics that you mentioned. What was going to happen in Q3, Q4, and next year Q1. It's my thought, and you can comment on that. Is whatever public spending government is doing the previous year, and right now they are doing it. Most of the effect on a transactional level, like transportation being easy, and there because of that the growth coming in. Those factors are still kicked in, or that might be one of the factor that you will get 0.3, 0.4% jump in GDP that we can expect because of the spend already being is part of execution. This is all WIP. The real result will take some time. I'm sure that's what I'm thinking. Like whatever connectivity through trains or through road, that network that's getting created will take some time to kick in and start giving an incremental 0.2, 0.3% growth. Is it a right assumption to make for, or it's already being taken care now in our GDP growth?
See, I think that's why our potential GDP growth of 6.5% is still higher than the outcomes we're expecting for this year and next year. So yes, there is some medium-term improvement from logistics and from infrastructure that we're kind of building into our numbers. So yeah, I would agree with you. Some benefit of that is yet to be materialized.
Yeah, Aditi, when I see the numbers, for next year, you're mentioning 6.2, 6.3%. Considering that we are getting into an election year. So are we considering that same status quo from a government perspective, or do you see some turbulent times if the election results are going to be different than the expectations?
So the baseline obviously doesn't factor in economic turbulence, and I don't usually like to color my economic forecasts with politics. I'm too much of a purist for that. But yes, I mean, we are expecting the elections to go through with, obviously the vote share and the number of seats in the Lok Sabha could very well go up or down. But we're not expecting it to be we're not building in a disruptive election result into our forecast. Let me put it that way.
Thank you.
So thank you so much for your views. I literally found them to be very, very thought-provoking and also very informative. So just two quick questions. What is your industry outlook? That is growth versus degrowth. Which industries to bet on? And what do you think will be the cost of credit impact for different industries?
Okay. So see, what has happened since COVID is that we've seen consumption being extremely uneven. So there have been periods where everybody's consumption has swung in one direction versus another. And I'll just give you, some anecdotes. I mean, initially when the lockdown started, first we stocked up on groceries, then we stocked up on what we needed for work from home and school from home. We just had to keep adapting very quickly. And so everybody's consumption sort of moved in the same down the same path. Then there was a period where there was a little bit of ease in the labor markets, migrants were back from the villages, and I found every household I knew was getting carpenters in and getting work done and getting painting done, right? And then last year when we went back to work, everybody was buying formal clothes. We had to go back to office. Lifestyle goods suddenly came back. Parties restarted. Clearly those higher end items were flying off the shelf. Last summer, all of us would have taken as many holidays as our bosses would allow us to. So spending shifted to the services sector, to experiences. Every time I go to Bombay, I find that my hotel costs more. Ticket prices keep moving. So it's just this like shift in demand which is going on and on happening through the economy, and what we expect is that going forward also it will remain very uneven. Now a lot of what I talked about is stuff at the higher end of the pyramid in terms of higher end demand, and that's definitely where we expect that lifestyle goods are going to do very well, lifestyle experiences will do very well, and there will be a prioritization of services over durable goods, because a lot of what you needed to replace on the durable side you would have done in the 2 years of the lockdown where you really couldn't go out and spend money on other things. At the lower end of the pyramid, there is a great aspiration to spend, and there is a great aspiration to improve one's lifestyle. The catch over there is going to be whether we can create meaningful jobs going ahead. But I find that young India is extremely aspirational, and I think that is something that is going to keep our domestic economic momentum going and hold us in very good stead if we are able to find decent organized sector jobs for a large number of people coming into the workforce with questionable degrees. Maybe, I don't know how many people will actually be able to go to college and get a good degree, and with maybe some hidden skills which are actually quite useful. So we have to be able to employ those people in a meaningful manner going ahead, and I think that is something that is going to be important. So coming back to your question, those sectors of manufacturing which are going to be able to cater to higher end demand are certainly going to do very well going ahead. But even at the lower end of the pyramid, the demand to consume remains quite high. So over there, if lower commodity prices can be pushed through to lowering the price point, I certainly see volumes being quite successful, barring periods where the inflation is pinching a bigger hole in the pocket. So one thing that we were seeing a couple of months back was that last year the demand for festivity was very high, because after 2 years of COVID, finally you could breathe, you could celebrate. A lot of people, a lot of families lost dear ones in the pandemic, and so last year was like this desperation to celebrate no matter what, no matter where inflation was, people celebrated with gusto last year. This year we were seeing that it is going to depend on where inflation really is. Thankfully inflation is eased off, and I think it's not going to be such a huge factor in people's minds during the festivity time. So hopefully this is going to turn out to be a good festive season. But micro markets, we are going to, or in certain sectors, we are going to have to be very watchful. Like if I remember correctly, if we average out the auto sales, vehicle registration numbers over September and October, it's looking like just a 4 to 5% growth. And obviously that's because Shraddh shifted, so we are, averaging these 2 months. But for the entire festive period as a whole, we'll really have to see where the next month's numbers end up to get a better indication of how much that demand is going to sustain going ahead. And rural, yeah, we expect rural demand to be quite cautious until we have like a really good, steady monsoon coming in next year.